Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance. And boy oh boy, do we have a treat for you today. We're diving deep into Healthpeak Properties Incorporated's latest annual report. And let's just say, predicting the future in real estate is a lot like predicting the weather complicated, but we'll give it our best shot. Did Healthpeak just have a great year, or are things starting to get a bit shaky? We're about to find out, and hey, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below. Come join the conversation. Let's jump right into this massive filing. So Healthpeak Properties Incorporated Doc is a big player in healthcare real estate, owning, operating, and developing properties focused on healthcare. Think medical buildings, labs, and senior living places. All across the US, they do this fancy split where they own the properties through a subsidiary called Healthpeak Op Incorporated. Now, a really interesting thing happened in March 2024. They merged with Physicians Realty Trust Incorporated. This was a huge deal, adding a massive 299 outpatient medical buildings to their portfolio. And get this, they're also planning to spin off their senior housing business into a new company called Janus Living Incorporated through an initial public offering or IPO, which they expect to complete in the first half of 2026. They'll still keep a big chunk of it, so they expect to keep including Janus Living's financials in their own. It smells like a strategic move to unlock value in that specific part of their business. Okay, let's talk about the money. For the year ended the 31st of December 2025, Healthpeak's net income available to common shareholders took a pretty big hit. It dropped from about $242 million in 2024 to just over $70 million. That is a nasty 70% plunge. The big reasons here are some nasty impairment charges on their lab investments and a big drop in gains from selling properties. It seems like selling off assets was a lot more profitable in 2024 than in 2025. But wait, there is a glimmer of good news. Their NAREIT FFO, which is a key measure for REITs, actually went up. It grew from about $1.09 billion in 2024 to over $1.26 billion in 2025. That is a solid 16% jump. And their AFFO, another important number that measures cash available for dividends, also increased, going from about $1.14 billion to over $1.18 billion. So, while their reported profit looks rough, the cash flow from their ongoing operations seems to be getting stronger. That is a classic case of accounting rules versus actual cash generation. Looking at their outpatient medical properties, the story is pretty good. Their adjusted NOI, which is a measure of property operating income, grew by about 3.8% for their merger. Combined same-store properties, that means the properties they've owned for more than a year are performing better, which is exactly what you want to see. The total portfolio also saw a good increase in adjusted NOI, thanks to all those new buildings they acquired. Now, their lab business, that is a bit more of a mixed bag. While their same-store adjusted NOI saw a small boost of 1.5%, the total portfolio's adjusted NOI actually went down. This is because they sold some lab buildings, which impacted the overall numbers. It seems like the lab market is facing some headwinds, perhaps due to increased competition or slower demand in certain areas. Their senior housing segment showed some real strength though. The merger combined same-store adjusted NOI jumped by a very healthy 12.6%. They saw higher rates for resident fees and better occupancy, which is fantastic news, especially with those favourable demographic trends for senior living. Digging into the revenue across all their segments, it is a story of modest growth. Rental and related revenues from their outpatient medical and lab properties climbed a bit from 2024 to 2025. Resident fees and services in senior housing also saw a good increase, showing that segment's continued strength. One area that really popped was their interest income and other. It jumped significantly from $44.7 million in 2024 to over $61 million in 2025. This likely comes from some seller financing they provided on properties they sold and new loans they originated. It looks like they're finding ways to make money not just from rents, but also from lending. However, with that increased borrowing, their interest expense also climbed quite a bit, from about $280 million to over $305 million. They took on more debt, partly from the Physicians Realty Trust merger and issuing new, more expensive notes. This is the double-edged sword of growth you have to watch out for. The good news on the cost front is that their transaction and merger related costs dropped dramatically, which makes sense as the big merger is behind them. It went from a massive $132 million in 2024 down to just $25 million in 2025. However, they did have costs related to that planned Janus Living IPO. When we look at their cash flow from operations, it looks excellent. It increased by a whopping $181 million, going from about $1.07 billion in 2024 to $1.25 billion in 2025. This boost primarily comes from that growing adjusted NII from their properties and those new acquisitions continuing to chip in. Their real estate footprint is massive. As of the 31st of December 2025, their gross asset value was over $20 billion. The largest chunks are in outpatient medical and lab properties, with senior housing also being a significant player. They've got over 680 properties in total. The value of their buildings and improvements alone is over $16.5 billion. This shows the sheer scale of their real estate holdings and the ongoing investment in maintaining and upgrading them. Now, let's talk liabilities. Their total liabilities are sitting at over $12 billion. A big chunk of that is their debt. They have over $8 billion in various loans, notes, and credit facilities. They are actively managing this, issuing new notes and repaying older ones, but it is a substantial amount of leverage. Despite the debt, their total stockholders' equity is still strong at over $8.1 billion. This means that even after accounting for all their liabilities, the company still has a lot of underlying value. Now, for the shareholders, dividends are important. They paid out about $1.22 per share in dividends in 2025, a slight increase from 2024. They even transitioned to paying these dividends monthly, which can be a nice perk for investors. They also bought back about 5 million shares of their own stock in 2025 for around $94 million. This is a common strategy to return value to shareholders when they believe their stock is undervalued. Okay, let's not forget the risks. Healthpeak faces a ton of them as expected for a company in this sector. Regulatory changes, especially around healthcare policy, are a big one. They are also very sensitive to macroeconomic trends like inflation and interest rates, which can drive up costs and make borrowing more expensive. Changes in the life science industry itself are a risk for their lab tenants, and of course the possibility of major tenants going bankrupt is always a concern. Their focus on healthcare real estate makes them vulnerable if that sector faces a downturn. And then there is the Janus Living IPO. They acknowledge that it might not happen, or it might not go as planned, which could impact their strategy and expected benefits. It's a sign of smart risk disclosure to be so upfront about this uncertainty. This filing paints a picture of a company in transition. The merger with Physicians Realty Trust clearly boosted their operational cash flow, as seen in the rising FFO and AFFO, and the strong performance of their core outpatient medical segment. However, the reported net income is being dragged down by accounting items like impairments, likely related to their lab investments and the sale of some assets. They're also taking on more debt as expected with a large merger and expansion, which is increasing their interest expenses. The planned IPO of their senior housing business is a big strategic move that could unlock value, but it also carries its own set of risks and uncertainties. So, what is my take? Healthpeak seems to be navigating a complex environment pretty well from an operational cash flow standpoint. The revenue growth in senior housing and outpatient medical, along with their ability to manage costs effectively, is promising. The lab segment needs careful watching, especially with the reported impairment charges. The debt level is significant, but typical for a company of this size and stage, and they seem to be managing it with a mix of fixed and variable rates and hedging strategies. The Janus Living IPO is a crucial next step that could significantly reshape their future, but the market conditions have to be right for it to be successful. Overall, Healthpeak is trading at a healthy dividend yield and has a solid base in essential healthcare real estate. The key will be how effectively they manage their debt, execute on their strategic plans like the Janus Living IPO, and navigate the potential pitfalls in the lab sector and broader economic landscape. What do you think about Healthpeak's strategy and its financial performance? Let me know in the comments below if you found this breakdown helpful. Be sure to smash that like button and subscribe for more deep dives into company filings. And don't forget to join our Discord community, link in the description, to continue the conversation and learn together. Thanks for watching, and I'll see you in the next one.